Good afternoon, everyone. Welcome to the webinar. My name is Brian Donald. I'm Investments Business Development Manager here at AJ Bell. And I'm joined today by our regular presenters. We have our Head of Investment Solutions, James Flintoft, and our Head of Investment Research, Paul Angell. Afternoon, chaps.
Afternoon.
Yeah. So we're going to be running through the following agenda. We are going to be starting off with a review and an update on how the business is doing. We'll then be looking at economies and markets with James and Paul before we get into sort of the main part of the presentation, which is sort of looking at the latest asset allocation review, which we've just completed, and the resulting portfolio updates. I'll then come back on to have a look at performance, looking at recent performance and having a look through some of the numbers there, and then we'll wrap up. We're expecting the webinar to last for 1 hour. If you have a question, you can ask your questions, just type them into the chat box, and we'll endeavour to take as many of your questions as we can during the session. If we don't manage to answer a question, then rest assured we'll pick that up as a follow-up after the event. So if we can sort of begin with an update on the business. The investment business here at AJ Bell continues to go from strength to strength. The last figures reported that we have on AUM, our assets had risen to 8.9 billion. So a big thank you to everyone who has supported us. And over the last year, over the course of 2025, we picked up another couple of industry awards. We won the Best Growth Portfolio at the Citywire Investment Performance Awards. That was for the passive MPS 5 portfolio. And then we topped the Flexible Investment category at the Investment Week Awards with our Adventurous Fund. So always good to get independent recognition of the job that the team are doing, and I hope that is a source of additional reassurance for you. So at that point, then I will hand over to James and Paul to have a look at the what's been happening in economies and markets.
Yeah, thanks, Brian. Exactly like that, James. If you could start off by showing us some of the market update slides, and perhaps you and I can talk from them.
Yeah, sure. So I suppose first things first about 2025 in terms of performance. What we saw was a broadening of the market. So we saw a broad range of asset classes performing well, particularly riskier assets such as equities and higher risk bonds. And that breadth of the market really played into the hands of diversified portfolios such as ours. So it was a good year, as Brian has said, for performance there. There were obviously some disparities in terms of performance, in particular the underperformance of the US when you think in sterling terms for UK investors. Actually, the weakening of the dollar over the course of the year was a big headwind to overcome, and therefore US-based assets faced a headwind there. If we think perhaps on the flip side of that, where currency was stronger, actually the euro versus the pound was strong, and that was a tailwind for European assets. And you can see there in terms of European equities, best performer last year. And those of you who are on the call this time last year will remember how we rotated into European equities last year, and that's paid off well throughout the course of the year.
Thanks, James. Can you give us a bit more colour on what was driving some of those currency market movements? Why was the dollar weakening, and why was the euro strengthening over the year?
Yeah, so in terms of the weaker dollar, I think firstly an undermining of confidence in the US, obviously around Liberation Day earlier on in the year, and also around the fact that the Fed has been pushed to cut rates quickly and has set off on that journey and been much quicker than other central banks. And as you can see here in this slide, that why have they been able to cut rates? Well, it's because headline inflation has started to come down a little bit and provide a bit of relief. It's still way above the 2% target, but it has been coming down. Obviously, a bit of a counter move in the UK this morning, but still a very mixed picture. But generally, the direction of travel throughout the course of this year and certainly into the summer should be downwards, and that's allowing central banks to cut rates, and that's been a good thing for bond markets in general. As I said, the dollar's seen some weakness on the back of that. So too on the confidence front as well. But as we've seen that weakening, that lowering of interest rates, we've seen a steepness in the yield curve, which is interesting to us. If you just look on this chart I've got up on the right hand side in terms of the UK and the US curve, where we are about now relative to where we were a year ago, you can see that relative steepness of where we were a year ago and the dotted lines there. So there has been better compensation for longer duration assets at this point in time, but not quite enough in our view, and I'll come on to that a bit later on as well.
Okay, thank you.
I think about the return profile for bond markets in general last year. As I said earlier on, the riskier bonds performed well, so particularly high yield bonds that we include in our portfolios, which we hedged back to sterling, so we take the currency risk out of things. They had a very good 2025, as you can see from that red line on this chart here, followed by UK corporate bonds. They performed well, so as credit spreads have tightened through the year, corporate bonds have generally speaking been the place to be. Government bonds have seen some volatility, particularly in the UK, around that nervousness ahead of the budget. Actually, as we came into the year end and that budget cleared and we got a better read on inflation and the Bank of England would be cutting rates further, there was a bit of strength and support in the bond market for gilts. So they did actually have a decent return last year, but a bit of a volatile journey, and particularly a volatile journey relative to cash. You can see here, cash is an important asset for our portfolios. You can see that straight line up and to the right, representing the cash return that we're receiving in portfolios, has been really important for anchoring the volatility of the portfolios over the last year.
Very good. And was the next slide on currency, James?
So next, I've got equities actually next, which you can see the currency influence here. So just put returns in sterling terms. You can see there the pink line at the bottom is that US equity market, although it had a very good 2025 in local currency terms, and indeed hit all-time highs throughout the year several times. Actually, when you translated those returns back into sterling, they were much weaker than what you got from other markets, and therefore portfolios that might have a focus on that area, particularly the market cap approach to global equities, really suffered at the hands of more diversified portfolios such as ours, where you saw particularly regions like Europe, as I've mentioned, but also emerging markets and China performing well on a similar theme as well, actually, that AI has become a much broader theme than just a US story. You've seen particularly parts of the supply chain in South Korea and Taiwan performing very strongly. And if you just take South Korea as an example, that was up 80% last year in sterling terms, driven by Samsung in particular. There in China, Alibaba and Tencent have really latched onto the AI trend with the release of their AI models earlier last year. You can see that led to some really strong performance through the summer last year, but that tailed off into the year end as there was a bit more focus on the weak consumer in China at the moment there. So generally speaking, a very positive year for equity markets, but certainly those ones that sit in a more diversified portfolio were favourable.
I suspect a few of us on the call today would have expected Europe to be top of the pops if we wound the clock back a year and looked at our expectations for the year ahead. What were some of the comments in terms of what's happened in Europe and how are we positioned for that market to do so well?
Yeah, so about a year ago, our valuation models flagged that Europe was looking relatively cheap versus the other regions. It had a bit of a political discount heading into the year end as lots of those kind of political issues were solved in 2024. There was no overhang, particularly in France. and actually in Germany as well. And actually what we got was a positive surprise in Germany through Q1 and Q2 last year, where there was a real momentum behind fiscal spending, particularly on defence and infrastructure, and that lifted sentiment towards Europe. And because it's particularly a relatively low weight in the world market cap equity index, that lifted sentiment and caused quite a lot of flow into the region, which was really positive for equity market performance, as you can see here. So yeah, something that was picked up by our models in terms of valuation, and we got a catalyst really quite quickly last year, so it was a real benefit to our portfolios.
Okay, thanks. Perhaps a comment on Japan as well. Obviously 16% for the year, very good returns, although within the context of some other equity markets a little further back. What was the currency impact there and the overall story?
Yeah, we've seen further weakening of the yen, some of which gets offset by market moves on the translation effect in the Japanese market. But yeah, somewhat weakening of sentiment around some of the political issues in Japan, and something that's coming to the surface in recent weeks, isn't it? That although there is a strong mandate for the new Prime Minister there, fiscal spending is very much on the agenda ahead of the snap election, and that's coming under real scrutiny in the bond market over there, which is having a knock-on impact on the equity market as well. But it has been relatively strong this year as well, so some of that underperformance reversing a little bit.
Okay, very good. So I think that's it for the market update in terms of what we wanted to talk about from last year. But do please send your questions in as we go, both on this and on the next topic, which is our 2026 strategic allocation. And I suppose the way to think about that is, in light of what happened in the markets last year and in light of what we're seeing in the markets from here, how are we positioning portfolios? So do you want to kind of give a broad update in terms of how we've gone about the strategic asset allocation process this year, James?
Yeah, so if I wind back to the process first, and think about the two parts of the process, really, the strategic asset allocation, and then on top of that, the tactical asset allocation. The strategic side is really focused on a model-based environment, so an optimization that gives us an efficient frontier, which shows us essentially the best portfolio that we can have for a given level of risk. And that takes various inputs.
Sorry, James, that's an optimization of asset classes, right?
Yes, yeah. So that's an optimization based, yeah. So it's an asset class level. So it's before thinking about the portfolio holdings. It's just that high level asset class level. And yeah, it takes a variety of inputs that we construct around expected returns, which I'll come on to, volatility and correlation. And of course, these are all backward-looking measures, so it's a historical view. It informs us around what the diversification of the portfolio should look like. But it is fallible because it is looking backwards. Therefore, we have the tactical element of the process where we use that to look at the model and the optimization around that efficient frontier and the asset mix that it gives us, and look for risks that the model can't see by looking backwards and what we can see looking forwards, and indeed opportunities as well on top of that. And the focus there is really on asymmetry. So can we find some really clear and obvious risks or opportunities out there that we can define well and want to act on? So as people know, we're not prolific tactical asset allocators in terms of we're not making lots and lots of decisions in portfolios week to week. It's slower moving by design to make sure that we really focus on these opportunities that are much bigger and big turning points in markets.
Is it worth just spending a moment on some of the rules that we set into the model in terms of the mean variance optimizer? Do we let it run with asset classes, or are we quite deliberate around setting parameters with which it can allocate to?
Yeah, so we are deliberate around that. So it's a constrained optimization. So versus an unconstrained one, which you just feed it the asset classes and tell you what the optimal portfolio is. It's constrained because we have a variety of investment policy statements, constraints that give us account for certain risks like concentration, liquidity, and currency around that. So it operates within the bounds of those constraints.
And just to bring it to life, theoretically at least, can you give us a few of those constraints that we apply to that optimization process?
Yeah, so around liquidity, there's a limit on particular types of bonds, so in particular corporate bonds and high yield bonds. On top of that, there's limits on how much currency risk we can take, for example, in emerging market debt. and in dollar-denominated debt in total as well. In terms of concentration, it's concentration on different markets. So how much risk can we take relative to the global market cap approach, to make sure that we're not looking into, you look at our portfolios, they are genuinely well diversified rather than having too much weighting in any particular region relative to that global equity market. So you won't see, for example, Japan. We do have a decent amount of Japan in portfolios, but it's single-digit exposure. It's certainly not as big as it is in the allocation to the US, obviously the biggest market in the world, and it couldn't get that far because we have a constraint around that.
Yeah, so we've got kind of 2 and 3 times equity allowance versus MSCI World weightings as well, right?
Yeah, so that's part of that process, yeah.
Okay. Should we move on then to what the reset in 2026 has unearthed?
Yeah, so just thinking at a high level, before we get into that strategic and tactical side of things, we always look for marginal gains in our processes around the structure of our IPS and the model-based environment that we think of. And we have made a slight adjustment this year, not as much as we have in the last couple of years, but we have made a slight improvement to that model-based environment, and I'll come on to that. In terms of the strategic allocation, we've seen some rotation, particularly in the cash and bond mix, and then within equities, we've seen some rotation as well. And then on the tactical side, some continuing themes from last year and what we're thinking about, so particularly around inflation risk and what that means for the bond market. And then on equity diversification, particularly obviously around the US equity market, but what it also means globally as well. And I'll come on to that.
Okay.
If I start with those structural changes in terms of what that model-based environment looks like. So we feed it a limited number of asset classes to ensure that it gives us a good quality optimization rather than having too much noise to deal with. This year we've introduced two asset classes that we included historically in unhedged form, and asset classes that we could have tactically allocated to at any point in time. But we included them in the model-based environment to give us a better sense of what diversification we should have in terms of bonds. So you can see here on the right-hand side, the chart, the table gives you the volatility historically of each asset class that we feed into the model. You can see there the difference between money market and cash, and the next volatile asset, which is gilts at 8%, is quite a bridge. So we looked at that very closely and what we could use to fill that void. And we've introduced hedged versions of global government, global corporate bonds, as you can see, which are low volatility. So it gives the optimization something to look at in terms of lower risk asset classes rather than being crowded too much in cash or gilts.
And why that is quite a steep change in step change in volatility for those asset classes versus the UK equivalent. Why is that, James?
Yeah, so it's really about what's under the bonnet. So obviously in the gilt market, it's just UK government debt, whereas when you're going into the global government market, you're going to the US, you're going to Europe, you have some of the UK in there, you have Japan, you have China. So it's much more diversified in terms of the issuers underneath that. And the same on the investment grade side of things, relative to the UK investment grade market. Isn't just UK companies, it's just global companies issuing bonds in sterling. But the global market is much more diversified by a number of issuers. So diversification under the bonnet is the key there.
Okay, thank you.
So just to kick off in terms of where we would be in the optimization and what we were showing the optimization of that model, we had two key themes running through things from a bond and equity side of things. So the key input to that process that changes relatively frequently is the expected return. So we look to forecast long-term expected returns based on what valuations are telling us in the market. The big change in bond markets last year was that obviously as cash interest rates start to come down, gilts and global government bonds start to look more attractive, and actually their yields crept up over the year as well. So they're looking ever more attractive. And they were also looking better relative to corporate bonds as credit spreads declined over the year. Corporate bonds were looking to be a better relative yield to that, relative to their potential volatility there. So the potential to rotate into global government bonds was something that was flagged into the model via valuations. On the equity side of things, and as we saw last year in our expected returns, a narrowing in the expected returns across the regions. So good performance from some of those regional markets, particularly Europe and emerging markets, saw their valuations rise relative to other regions. Whereas in the US, actually, although it's performed strongly, it's been backed up by earnings growth. So the valuations haven't really changed that much. So although there's a lot of noise in the market around valuations in the US, they haven't really changed that much year over year, whereas they have in the other markets, because it's all in expectations of future growth, whereas in the US, we're seeing that earning growth delivery right now. So a narrowing in the valuation discount for the regions versus the US, which we'll see in the optimization has prompted some rotation there as well.
Yeah, it's also worth touching on the change of assumption within emerging market growth rates, given how we see global growth dynamics.
Yeah, sure. So under the bonnet of how we construct these capital market assumptions is several assumptions that we make. So alongside the valuation, so the earnings yield, we take into account the long-term growth potential of each market. Historically speaking, we've applied different growth rates to different markets. We've started to become increasingly aware that might bias some of the relative values there. So we've harmonized the growth rate across the region, so they're all growing at the same regional growth rate, and that stands to reason in a couple of areas. But if I like to kind of give one example, I think about how the growth in emerging economies, particularly in China, for example, over the last 20 years, all of that growth has not been captured within the Chinese equity market. Some of that growth has leaked out into the global equity market, particularly into developed markets. If you think about luxury goods companies, so that growth of the middle class in China and that aspirational buying power has led to incremental profits for European luxury goods companies such as Burberry, LVMH, etc. They've extracted some of that growth from China. So it's reasonable to expect that growth, although you do see differences at a country level, is spread out across the global equity market in terms of the returns.
Okay, should we move on to see what some of these assumptions have done for our strategic and then tactical position?
Yeah, so yeah, start on the bond side. We've seen a rotation, as I said, from cash and higher risk bonds into government bonds in the UK. We've looked at that tactically and thought about the risk building in the UK government bond market and how that looks relative to the global government bond market. And a lot of the themes are very similar around political risk, fiscal risks, etc. But we think tactically that we should have greater diversification in our government bond holdings. So we've tilted slightly away from the UK and continue to hold US Treasuries, but also diversifying further into Europe as well. But that diversification stops there, really. It doesn't expand into Japanese government bonds, for example, so we don't hold any of those. And we don't hold Chinese government bonds as well, which are also a big part of the world market as well there. On the corporate bond side of things, there's been a shift out of UK corporate bonds into more global corporate bonds, as I said earlier, a shift towards greater diversification. We've looked at our allocations, particularly in high yields, and thought closely about what value is on offer in the world market. I'll come on to that in the next slide. And then just to round things off, as we did last year, we've thought about the debate between nominal yields and real yields. Last year we used inflation-linked bonds in the US, so US TIPS, hedged back to sterling to great effect to dampen volatility in the portfolios and earn a very good return over 2025. We still think they offer good value. We've used more of them this year, and we've added UK inflation-linked bonds as well. So, and I'll come on to that.
James, just on the reduction in emerging market debt. I mean, the textbooks would say that a lower US dollar should be good for those economies and therefore good for their debt markets. Any comment as to why we're strategically reducing EMD?
Yeah, it's really as a function of that optimization environment. So that has given a lower expected return in that market over the year. It has actually performed well on a currency hedge basis over the year. As I said, riskier bonds have done well, spreads have narrowed. So it's really just taking account of that. There's been a slight reduction in the allocation there, but not a significant one. We still hold emerging market debt, and it gives us really good diversification in bond markets.
Okay, all right, should we move on to look at some of these positions in more detail?
Yeah, sure. So I can think about that equity rotation here, just finally on this slide. As I said, that narrowing of the discount, the regions relative to the US has meant that we've seen some rotation away from them, particularly Europe, a bit in emerging markets, ex-China and Japan as well, and an increase in allocation to the US. And we thought really carefully about how we increase our allocation to the US, and if we wanted to, on a tactical basis, and we found some really interesting opportunities in sectors. So, and I'll come back to that later on in the slide. But if you look at the high level asset allocation, what that means per risk profile, there's still a strong allocation to cash, particularly at the lower end. It's an important anchor for our portfolios, with cash rates still relatively attractive, relative to the very little volatility that they give us, whereas the government bonds are obviously more volatile. You can see here, just in terms of the different risk profiles, that diversification that's been introduced now. We've got a lot more in global government and global corporate bonds through the range, so much so that we've got more there than we do in the UK market in some portfolios. And then on the equity side, you can see, again, still very well diversified there, even though we've had some rotation towards the US, increased US weighting, but at the same time, still got strong weightings in other regions. And I have to think about some regions that we won't talk about later on. As UK equities remain a really strong anchor within the equity allocations of portfolios. Firstly, valuations are good relative, and then on a diversification point, they give us really good sector diversification, because the makeup of the UK market is, for better or worse, at times very different to the global market. And that gives us access to different types of companies, whether it's cyclicals versus defensives, or different factors, or different sectors. So the UK market has been really important. And as a reminder, our allocation to the UK market is predominantly in the large cap space. So there's not a small cap in there, so we don't have any of that kind of domestic bias that you might see in other portfolios there. And then the second point on equities, an area that there's been no change, has been China. We still see good value there. It's an under-owned asset class, given the kind of geopolitical environment we've been through in the last year. For some would say for good reason, but a lot of it's in the price, and it's still giving us a really good, strong relative expected return there.
James, just on that UK equity positioning, I think you've made a good case for UK equities there, particularly in a balanced portfolio. Is that would you go as far to say that the position, the kind of high weight to UK, stands entirely on its own merits, or is there an element of home bias in there in terms of being UK invested and wanting sterling denominated assets? Yeah,
that's part of it, that we are constructing portfolios for sterling investors. Most of their liabilities in the future will be in sterling, and therefore sterling can be really important for the portfolios. That is to some extent in the large caps, taken out of the equation by the fact that there's obviously lots of overseas earnings in there, but also at the same time lots of corporate hedging policies that muddy the water. So it is an important point, but somewhat murky one in terms of the currency translation effect there. But in terms of what they bring to the portfolios, yeah, it does stand on its own merit. It's a really good diversifier relative to the global equity market. If I think about some of the risks that are building in some of the regions, particularly around this AI theme and the AI supply chain that we're now seeing permeate across emerging markets in particular, it is a really strong diversifier, because some people would be have been quite negative on the UK market because it hasn't had exposure to those tech names and that some of those kind of shiny parts of the market. But actually, if you look at it on a performance basis, over the last couple of years, it's had a really good couple of years here, particularly in the large cap space. The smaller mid caps have struggled at times, but that large cap space has been really strong. It does stand on its own merit in these portfolios. Yeah.
Okay. I think you've got a few more slides on our bond positioning next.
Yeah, so just to first focus on where we've got to in terms of our bond allocation. So just in the table on the right hand side, you can see where we are now in terms of those allocations, and beneath each region, you can see how we're tactically intervening. If you see a red box there, that's generally speaking, that's showing you where there's been a reduction year on year in that asset class, and the green one is an increase. So 3 points really here, that the short duration stance that we had introduced into portfolios in January last year stands. It's much broader in terms of the asset classes that it touches, but it's still broadly neutral year on year. And that's even though we've seen some steepness in the yield curve. If you take, for example, the difference between the 2-year and the 10-year yield in the UK, it has been steepening, 77-ish basis points between the two. Similar sort of level in the US as well. So you're getting a bit more compensation for taking on greater long-term uncertainty and volatility, but we don't see enough of it there. So there's broad-based short duration stance across the piece in different markets, particularly government bonds. The second point is really around real yields, which I'll come back to on the next slide, but you can see that we've introduced more in the way of US tips, so US inflation-linked government bonds, and UK index-linked gilts as well. Again, I'd stress there they are short duration. We're not taking on that kind of market level of duration, which is a big problem for how some allocate to index-linked gilts, is that market is typically a long duration asset class, 15 plus years of duration risk most of the time, and we were actually targeting the short duration aspect of that, under 10 years, which is keeps a lid on the volatility that we could experience, but also gives us that real yield, which I'll come on to. And the third point is that we still like high yield. It's been a good performer in our portfolios, as you can see there. Kept the allocations to the global high yield market static year on year. That is reduced relative to where we have been in the past. We've been in double-digit territory in the past, but in light of where spreads are, we are a lower allocation. But we have been looking for where we can find incremental relative value in that space, and we found some value in European high yield, where actually the credit profile and the sector diversification in Europe is much stronger, and actually you're experiencing a yield premium at the moment in Europe. So we've added some of that to some of the higher risk portfolios there.
James, just on the short duration positioning, and by which technically we really mean underweight duration, not that we are pointing the opposite direction to interest rate risk, but I mean, almost in every line in this portfolio, there's either a bracketed short duration or short duration in the kind of subheading, excluding high yield, which itself is a low duration asset class. I think gilts is probably the only kind of meaningful duration exposure that we've got there in the risk profile 6% towards the top of the slide. That's obviously a position we had on last year, as you said, which has done well for us. You've outlined why we're happy to stick with that position and move it around in certain different parts of the bond universe. What are we looking for to close that short duration position out? And is there anything, particularly in those low risk profiles, which we've spoken about as being really nicely protected from the drawdown potential of a duration sell-off? Is there anything that can lead us to actually lean into duration to more of a kind of benchmark weight, or even go overweight? What are we looking for in bond markets and global markets?
Yeah, as I've kind of said, that we're quite hawkish on inflation in the long term. I think the regime has changed in a way that the world, in terms of geopolitics, has changed a lot in the last couple of years, and it seems to be changing at an increasingly fast pace these days as well. And on top of that, the supply chain looks very vulnerable. It's liable to sharp increases because of that volatility, and all that that's one part of the equation. The second part of the equation is, are we being compensated for that inflation uncertainty? And we're not seeing the market really appreciating that risk. So although the yield curve is steepened, we think it should be a lot steeper. And that could mean actually a sell-off in the long end, rather than what we've seen this year is actually, if the long end's actually performed okay, it's not had a sell-off, but the short end has performed in terms of yield has come in much further. What we'd probably like to see is more of a steepening of the yield curve based on long end yields rising, and maybe short duration staying relatively static. So I think greater compensation around that inflation piece and the uncertainty that presents to portfolios.
Okay, thanks. I think your next slide's on the inflation positioning.
Yeah, so just as real yields have started to be more important for the portfolios over the last year, and as of this week, in this week's rebalance, I just thought I'd show what has changed in terms of the backdrop on real yields, and just showing some short duration real yields in the UK and the US. As you can see, kind of post 2022, that reset in the global bond market. We've seen positive real yields in both markets, but we've seen slightly different stories where the US market has priced in some better real yields and given us a much better relative return over the last year. Whereas in the UK, the adjustment has been much more gradual. The UK has some structural pressures on the yield curve, particularly from pension funds. Therefore, sometimes the yield adjustments can take longer, rather than being too reactionary in such a big and liquid market in the US. It prices things pretty efficiently, whereas in the UK, it's got a structural distortion. But we're seeing now incremental value in the UK at the short end in terms of real yields. So we're adding those to portfolios alongside those US holdings as well.
Okay. Thanks. So did you want to move on to some of the equity positioning now?
Yeah, so on the equity side of things, just to first show what that kind of model optimization wants us to do in terms of the rotation and that kind of unemotional look at portfolios and valuations. So as I said, we've seen a rotation away from Europe in particular after its strong performance, its rise in valuations. We still have a good amount in Europe, as you can see on that kind of top half of the table on the right hand side. But it's been trimmed, and some of that trimming has gone into the US there, where that earnings delivery has been really strong, and therefore the valuation is relatively static. And it's raised the question, although on a more sentimental basis, we and a lot of people are very positive towards European equities and think there's a good story to play out there around fiscal spending and the effect of the multiplier that we might see within the European economy of that spending. Actually, on an unemotional look at valuations, the model's telling us that we should be trimming our position, and we're following the model on that. Obviously, on the US side of things, that poses a really interesting question to us in terms of how we should allocate to the US, because the model can't see how concentration risk has changed over time. The market in the US is as concentrated as it's ever been, really, and that means that it might not perform in the short to medium term as it has done historically. So we thought long and hard about how we allocate to the US and whether or not there are any opportunities around that. And we think at this juncture, as opposed to where we were over the last year, there are some key opportunities emerging in the US in sectors.
Yeah, I mean, something I've just noticed on that last slide, James, is there we go, and by chance, but I suppose almost by design as well, that if you look at risk profile 5, we're pretty much a third split across the US, Europe, including the UK, and emerging market kind of Far East region, which is I suppose where we might want to get to, but obviously we haven't deliberately ended up in that kind of perfectly diversified endpoint.
Yeah, it speaks to what the model's looking for. It's looking for the best return that we can get with adequate diversification, and as you say, it leads us to many different regions and good allocations in lots of those regions, which is in stark contrast to what you get in the global equity market at the moment.
Exactly right. Okay, were you going to share some valuations of the different markets?
Yeah, so as I said, that we've thought long and hard around how we allocate to the US and whether or not we wanted to take on more of the market cap approach and what that concentration risk in that market meant. And we thought that there might be better opportunities in other areas of the market. And we've been watching some of these opportunities unfold for a while, and it gives us the opportunity to introduce some of these ideas into the portfolios where we see, valuations, starting valuations are low, as you can see on the top right chart here. You can just see that relative to the wider market, the sectors that we've chosen, so energy, healthcare, utilities, they are relatively cheap versus the market. They've got some relative cheapness relative to their own history as well. So it's not just relative to the how the market changed, but themselves are looking cheap on a relative basis as well. And when we've looked at these different sectors, we've been conscious of how we bias the portfolios in terms of allocating to defensives and cyclicals. Keen to not take too much of a particular tilt in that respect in the portfolios, as we see the outlook is probably quite bright for the global economy, even though at this kind of point in time most people are relatively negative on it. We do see a relatively benign environment at the moment, and one that could possibly improve with fiscal stimulus across Europe and in the US as well. So we wanted to be conscious of that tilt between cyclicals and defensives, and making sure that we're not tilting particularly too defensive at any point in time, and what blend of these sectors we could use across the portfolios, and also what was the story attached to any of these, what's the catalyst here for any of these sectors. And we think there are several out there. For one, so for example, energy, we think that the progress towards net zero might have slowed, and as we see this kind of AI technology advance and broaden, there's much more focus on the energy mix and what that might mean for the inclusion of fossil fuels in the energy mix going forward. And other people have been acknowledging that throughout the last year or so. That just take, for example, that the IEA now, the International Energy Association, now expect that fossil fuel use, in particular oil and gas, will actually increase over the next couple of decades, whereas they thought it would decrease after 2030 previously. So there's been a bit of a change in attitude around these at a time when the valuations for these parts of the market are very low, and the oil price is very low. We're all targeted in a way for what the US government want, but there is a strong incentive to keep energy prices low, but that could be subject to change. As I outlined earlier, the geopolitical environment has changed a lot, and the fact that we could find some positive catalysts for that sector going forward is not missed on for us. Okay. For the other sectors, so just quickly on the other sectors, healthcare and utilities, for example, we think that we're going in with AI, we're going in the direction of entering kind of a new phase of the implementation. The market's very focused on the supply chain around AI, who's building the chips, where are the chips coming from, where's the different componentry coming from, who owns the models and who's selling the models. We think the next phase is actually who is using the model to improve productivity in their businesses. We think one of those sectors is healthcare. We've just seen over the last couple of weeks, if anybody might have noticed the news from Anthropic, that they've launched a specific model for healthcare, Claude Health, where there's been touted to be a lot of productivity gains. Just take one example that I was reading yesterday around Novo Nordisk and how they've, so a big European health company, how they've implemented AI has actually reduced the time taken to fill out some of their paperwork down from 10 weeks to 10 minutes now. I think that's probably quite optimistic, but it shows that the scale of the improvement that's expected in some of these sectors, and the same too in utilities around that point, but also around the fact that the increasing demand on grids and need for these providers to be strong and resilient is really coming into focus at a time when valuations are really quite low.
Okay, thanks, James. I'm just aware of questions. Of time with 14 minutes left, and we're very keen to get to some questions as well. So do please use the chat function on your screens to get your questions in. As we get to those questions, we did want to touch on some implementation highlights. I know Brian's rightly very keen to talk to performance as well. So perhaps on the implementation first, James. I know you were going to hand over to me for some of this slide, but do you want to talk to some bits and then hand over?
Yeah, sure. So I think probably on the passive side, a lot of it driven by asset allocation, so not too much to drag out of it there. A really keen focus on that, finding products that provide the best value for money in each of those sectors. On the active side, we've seen some rotations, particularly in the UK blend. We've added in some greater quality in terms of the even load income. We've also worked in partnership with Artemis to launch an EMX China to provide us better choice at a really good cost in emerging markets. So I don't know, just on those two, Paul, I think those are the two standouts. You want to speak to your work that you've done with Artemis over the last 12 months around that?
Yeah, so you've taken some of mine and my team's thunder there, James, but thanks for that. So yeah, so on the fund research side, where we're looking for the best products in the markets to put into these portfolios, we've had some really good wins over the course of the year, as James alluded to, launching an Artemis emerging market ex-China. That's run by the SmartGARP team there, if anyone's familiar with them. And what we've been able to do is actually go to Artemis with the suggestion that they launched an emerging markets ex-China fund on the basis that they had a emerging market fund up and running, predominantly rules-based, that was performing exceptionally well, that we were buyers of in other parts of our business. And given our asset allocation has moved to breaking China out from the broader emerging market region, we said to them that we'd love you to partner with us on a new fund in this area, and then on the back of that, we've been able to benefit from exceptional pricing, really passive-like pricing within the emerging market region for that fund. Just launched last week, ahead of our trading into it yesterday and today. So really pleased with that development in portfolios. As we've seen, EMX China is a big part of portfolios, so it's not our sole holding in that space, but it's certainly an important component part for us. Maybe another one to talk about is the M&G Global Corporate Bond Fund. James spoke about how we've added global corporates as kind of a main asset class within our optimization process, and therefore my team have gone off to find the fund that we most like the look of there. Again, on the basis of our scale, we've been able to access a very cheap share class there. Again, passive-like fees at 25 basis points for a really good active fund that takes both macro and bottom-up decisions within positioning and led by a really high-profile manager within the M&G franchise. So a few really good wins, I think, coming out of the fund selection component of the rebalance. So yeah, lots to be pleased with, and of course we'll continue to work on trying to achieve better and better share class deals, and to launch new product and support new product where we can, where we have that level of conviction in the caliber of the management team. But certainly very happy with the makeup of both the active and passive funds within all the portfolios at the moment.
Thanks for that, Paul. I'll just cover off the final points on just to bullet point where we are in terms of positioning and the outcome of this asset allocation process. The key word in all of this is diversification. It's a big part of our process. It's a big part of our process that's been working really well over the last year. And it's something that we've looked to really focus on at this asset allocation update, particularly around bond markets, how we're diversifying away from the UK, how we're diversified in terms of real versus nominal yields, so introducing inflation-linked gilts, as I said, and how we're getting best value in terms of that credit selection piece with the addition of diversification as concentration rises, not just in the US, around the AI theme, but also across emerging markets as well. We thought really carefully about how we can complement that with sector opportunities that stand on their own 2 feet from a valuation perspective and outlook perspective as well there too. With that, I'll pass you back to Brian to talk about the performance. Brian, you there?
Thank you, James. Thank you, Paul. Right, so we've had a look back at what's been happening in economies and markets, and we've had a look ahead to how we've positioned the portfolios for the year ahead. To round things off, I'm just going to have a look at recent performance. So maybe just I'll take a minute here just to explain exactly what it is we're looking at here in this first chart. So this is our funds, our multi-asset funds, and what we're looking at here is annualized returns, and we're looking at relative performance versus the IA sectors that the funds sit in. So what the bars represent is the degree of outperformance or underperformance of our fund versus the IA sector that it sits in. And as you can see, we've got a variety of different time periods there that we've got the returns for. So I mean, the message here I think is that we've broadly outperformed, and you know, looking towards the top end of the risk spectrum, we've got some significant outperformance, and you know, I think the last year, the 1 year number obviously catching the eye a bit in this chart as well, reflective of the fact that we had a very good 2025. James and Paul have been speaking about how we focus on diversification, and we held a broad spread of different equity allocations, managing to capture a lot of the good returns that were available in the market, and we didn't have quite so much reliance on the US market, so that was beneficial. And yeah, just looking at the areas where the IA sector has outperformed, that's basically the last sort of 2 or 3 years in the lower risk portfolios. And that's really to do with the fact that obviously IA sectors include both active and passive funds, and it has been beneficial over that period to have a more hands-on approach to managing the bond allocations, and the AJ Bell funds, as you know, are passively implemented. We go on to the next one, James, please. The passive MPS. So the passive MPS, same chart. I mean, it's obviously very similar, given that these portfolios are quite similar to the funds as well. And then the next chart, we are focusing on sort of active versus passive. So if we have a look here, this is showing for each risk profile the passive MPS portfolio versus the corresponding active portfolio. So if we look at these bars, where the bars are above the baseline, that indicates passive outperforming active, and obviously vice versa. So we can see here that the passive portfolios have outperformed over 5 years, but more recently, over the sort of last 2 or 3 years, active has had the upper hand, and that comes back certainly in part to that point that I just mentioned about active management of bond allocations being beneficial. All of our performance results are, of course, available on the website for you to view. And then if we can just move on to the next slide, please, James. Okay, so we've reached the summary. So just by way of a recap, we've We've talked about economies and markets. Obviously, the story of Q4 was one of cooling inflation and rate cuts, which helped bonds. And we also saw the AI theme coming through strongly across EMX China. And more broadly in 2025, we were speaking earlier about how it was the riskier bonds which performed best on a GBP hedge basis, and the equity rally really broadened out. So you know, we saw good performance from a number of different regional markets, rather than it just being centered on the US. We also talked about our asset allocation for the year ahead, and the key takeaways there, obviously on the bond side, continued focus on managing inflation risk, which we're doing through short duration and inflation-linked bonds, as James was describing. And on the equity side, an upweighting of the US allocation, and taking sector positions as part of that US allocation going forward. And then the outlook to finish off. Obviously, global economy, you know, there's reasons to think that it might perform better than the low expectations we've had, but there's a couple of risks to be aware of, namely sort of geopolitical risks to inflation, and that equity market concentration risk that we spoke about, which we're addressing through our sector diversification. So I hope that's been a useful summary. I'm going to open it up now to any questions. So if you have any questions, do pop them in the chat box, and we'll endeavour to answer them for you.
Thanks, Brian. To kick us off on that front, maybe then, I know we're right out of time, so any more questions, do get them in the box as soon as possible. Let's bring it right up to date, James, in terms of what's been happening with Greenland and NATO and President Trump flying into Davos. What are the expectations that we're expecting here on markets or implications, and then how might we be thinking about the portfolios in light of those?
Yeah, I think probably on the, you know, what we're seeing more recently is obviously an acceleration of geopolitical risk, you know, centering around the US being the instigator rather than being reactionary. But I suppose in a sense, it's really just a trend that we've seen as ongoing for a couple of years now, that you know, the world is fragmenting in a way, that the US is becoming more forceful, and you know, taking actions to start controlling elements of its supply chain, for example. You could argue that's what's happening in Venezuela and South America, for example. It's been much more strategic around some of its positioning, particularly, you know, relative to its rivals in Russia, if you think about Greenland and the Arctic as well. So probably, you know, something that could continue for, you know, a little while longer. I don't think it's something that is unique to and is aware with Trump. I think it's something that's deeply embedded within the US, that they want to be more in control and exerting their power more, and therefore there's, you know, greater risk of volatility around the supply chain. I think that's the key one there. Is the upshot is that you know, we are most of the Western world very reliant on cheap goods coming out of China in particular, which is positioning itself as a rival to the US. And on top of that, as part of a carrot and stick approach from the US administration, they are attempting putting in place lots of tariffs, as we've seen again, that kind of, you know, trade war being reignited over the last week, and that means that, you know, the supply chain potentially can get you know, knocked around a little bit, both in terms of prices, but also in terms of, you know, security of supply, and that looks inflationary. I think as we said in April last year, it all feels inflationary, doesn't it? The trade war. It's just that markets are looking at it from a very short-sighted perspective, that they're looking at the current inflation figure and the downtrend that we're seeing, and some people are still estimating that the UK might hit 2 or 2.2% inflation by the summer. That would be great. That would be welcome news. But obviously, there's great risk within that figure, as we saw today with the service side of the economy. Inflation is really sticky still. It doesn't take much of a change on the goods side of the economy to cause a flare up in inflation. So the takeaway from me of the last couple of weeks is that this trend is really ongoing around geopolitical risk and that the inflation risk that's associated with it.
Okay, thank you. We have had a flurry of questions in, so thanks for those listeners, and we are out of time, but we can stick around and answer them, certainly, for those who can stick around as well. Can you remind us, James, perhaps briefly, why there's no specific commodity allocation or exposure within the portfolios?
Yeah, so it's something that we talk about a lot, and obviously, given that in light of the recent performance from precious metals, something that's coming in the spotlight. So what we think about in terms of our asset allocation structure, it goes back to our thought process and our mantra around simple, transparent, and low-cost investing, and sticking to the asset classes that fulfil that kind of mandate. So that leads us to equities and bonds. Beyond that, what do we think about? We think about the diversification benefits of an asset class. So if you go back 12 months ago, we pulled out some of the alternatives that we were using in terms of property and infrastructure equities, because they're equities at the end of the day and weren't giving us enough diversification in their own right as asset classes. As part of that, we look for asset classes that we can price, that we can value quite consistently, and with a reasonable error band in terms when we're thinking about long-term expected returns. And with bonds and equities, you can immediately focus on either an earnings yield or a yield to maturity, and that neatly fits into our process. Commodities, although you could argue that they are simple, transparent, and low cost to invest in a sense, they can be very volatile at times, as we've seen with the gold price. It's been good volatility so far, hasn't it? If I wind back to, I think it was November last year, the gold price dropped 7% in 24 hours. I'm not sure that's what we would want from a low risk asset class that's intended to protect portfolios. And that's but the bigger point around gold in particular, and any commodity, is that how you value it, and it is difficult to value. Its relationship with real yields is fleeting and is broken down, so you can't rely on that. Given there's no cash flow or earnings yield, it is very difficult to value. So on a forward-looking basis over the long term, it is very difficult to give a valuation for it. That's not to say that it can't warrant a place in people's portfolios, but in our portfolios, it is a difficult one to include.
Yeah, and I suppose outside of the technical kind of exact commodity allocation, we do have a lot of commodity exposure within our UK equity holding as well, with quite a miners and materials heavy market there as well. Next question then, how do we formally review our TAA decisions, and do we have exit levels? Do we have levels that will top positions up at? How do we ensure that we're remaining live and nimble with those positions?
Yeah, so every proposal that we put forward in terms of a tactical position comes with it a set of exit conditions that, if breached, it'll prompt a formal review or exit of that position, depending on how the market environment changes. Obviously, at the outset, you can be targeting a particular risk that may evolve over time, so those exit conditions might need to evolve over time as well, but we have them included. They're on, as I said, on an ongoing review. They go through our governance structure for review as well, formally. So yeah, it's really quite disciplined around that tactical element. It's not narrative based, as it were. It's very it's rooted in actual facts and figures and what we can ground ourselves on rather than too much in the way of narrative.
Okay, very good. Thanks for that. And can we get a little bit more comment on the UK linkers position, please? The person who's put the question in says, I thought they've been excluded previously due to idiosyncrasies in the UK.
Yes, yeah. So there's a paper actually up on the website around the issues with index-linked gilts, and the big issue with it from a broad asset class perspective is that that it might not protect you from what you think it might protect from. So when you buy inflation-linked bonds, everybody thinks that they can protect you from inflation, but actually the bigger risk can be duration. And structurally, the way that the UK market is has evolved over time has meant that the index-linked gilt market is long duration. So if you go out there and buy the standard market, you're getting 15 years plus duration straight off, which is far in excess of the risk that you face in terms of inflation pricing in those bonds. So it's actually, when you buy those bonds, you're taking a duration bet rather than an inflation bet. So they're not included in the optimization. We reserve them for that kind of tactical piece. And this year, tactically, we've focused in on what the real yield is and how little duration risk we can assume when taking that on. And actually, the way that the curve is positioned in terms of UK linkers means that you can get quite a good real yield, historically speaking, given what environment we're in at the moment regarding inflation, for very little in the way of in terms of duration.
Okay, thank you, James. And the final one we've had in is around benchmarking. It's a question we've had before, and it's around why we use the IA buckets for our benchmarking, given they're very broad, and whether or not there'll be better indices out there like ARC indices. What's our view there?
Yeah, and we're happy to provide analysis versus different indices and benchmarks if we're able to, upon request, if need be. We use the IA ones because they are broad and very well used across the investment industry in the UK, and we want to be as broad as possible in terms of interpretation of the funds.
Okay, that was it for questions. So back to you to close, Brian.
We just got a couple more slides. Yeah, just a reminder, you can keep up to date with all the latest communications and literature that accompanies the service on the investment asset page of our website. So have a look on there, and you can download a whole host of different resources. So I think we're at the end now, just the final slide.
Maybe just one more point on the IA sectors, just to say that they're obviously not benchmarks as such, but rather they're references in terms of what the peer group is doing, rather than anything we're managing to within the portfolios themselves.
Yeah, thanks, Paul. Okay, I think that wraps everything up for today. There will be a short survey after the webinar ends, which would encourage you to complete. We'd be very grateful if you could complete that, and we'll send out the usual post-webinar follow-up by email, copy of the slides, etc. So thanks ever so much for watching today, and we'll be back with another update soon.
Thanks all.
Thank you.
Thank you.